What is an exchange-traded fund, or ETF? It's a question more and more investors are asking. ETFs have emerged as one of the most exciting innovations on Wall Street, reshaping the way investors invest and helping them build better portfolios with lower fees, greater tax efficiency, and increased transparency. My name is Dave Nottig, and I'm the Director of Research at IndexUniverse.com and the Exchange Traded Funds Report, the longest-running ETF-focused newsletter in the world. This presentation will examine the basics of what makes an ETF an ETF, how it differs from a traditional mutual fund, and why you might choose an ETF over a traditional mutual fund, or vice versa. We'll walk through what to look for when evaluating funds and review some of the potential pitfalls you should be aware of. ETFs have changed the landscape for individual investors, much like mutual funds and 401k plans did in the 1970s and 1980s. ETF assets have grown from a base of nothing in 1993 to nearly $2 trillion around the world and nearly $1 trillion in the US alone. While this is still just 10% or so of the mutual fund industry, on a daily basis, ETFs can represent as much as 30% of the traded volume on US exchanges. Individuals and institutions are using these ETFs to get exposure to virtually every global asset class in a simple, easy-to-understand package. This presentation goes under the hood. So what is an ETF? Well, one of the most important things to understand is that an ETF is really just a special kind of mutual fund. It's a structured pool of assets, much like a mutual fund. It has a manager who manages the assets in the ETF just like any index tracking mutual fund would. And for the most part, it's regulated like a traditional mutual fund. But an ETF is a mutual fund with a twist hinted at by the name, Exchange Traded Fund. An ETF is a mutual fund that can be bought and sold on an exchange just like a regular stock, and that means you can buy it from any traditional brokerage account and trade it just like you'd trade IBM or Cisco. And whereas traditional mutual funds buy and sell orders are processed just once per day at the close, ETF trades are immediate. You can buy or sell an ETF at any time, even buy it in the morning and sell it in the afternoon. You can also do things with ETFs that you never dreamed of doing with mutual funds, such as shorting them or buying them on margin. They are exchange-traded funds, and those two words make all the difference. To understand how an ETF works, you first need to know how a mutual fund works. Let's start from square one and imagine that you are creating the first mutual fund in the world. You and 3 of your friends each have $10,000 that you want to invest. You don't have the time or expertise to manage that money yourself, and besides, it's hard to build a diversified portfolio with just $10,000, so you decide to create a mutual fund. You put your money together into one pool of $40,000. In return, you each get 100 shares worth $100 each, since 100 shares times $100 per share equals $10,000. You then hire a professional money manager to invest the full $40,000 in the market for you. Now let's suppose that the manager does an incredible job, and after a certain period of time, that $40,000 is worth $80,000. Now each share of that mutual fund is worth $200. Now you decide to sell. You can call the fund manager and tell him you want to redeem your shares, which are now worth $20,000. The fund manager must go into the market and sell stocks worth $20,000 in order to pay you. Conversely, if another investor wants to buy shares, they could do so for the price of $200 a share. They would simply send their money to the fund manager, who would go into the market and put that money to work. It's a nice arrangement. The fund manager is paid a fee for her efforts, and investors get the exposure they need. In practice, of course, investors don't launch their own mutual funds. They buy shares in existing funds, like Fidelity Magellan or the Janus 20. But the process works essentially the same. Sometime during the day, you decide to buy shares in a mutual fund. You place a buy order, either by sending a check directly to the mutual fund company or by placing an order through a brokerage account like Schwab or E-Trade. Either way, you're effectively sending your money to the mutual fund company. In the mutual fund world, the process of collecting buy and sell orders takes place only once per day. No matter when you decide to buy or sell shares, the mutual fund company processes that order after the close of trading at 4 p.m. You can enter your order at 11 or 3, but it still won't be processed until after the close. Once the fund manager receives the money, they'll deliver an equal value in shares of the mutual fund. The price per share is based on the value of the stocks, bonds, and cash that the mutual fund holds, divided by the number of shares outstanding in the fund. This price, determined after the close of each trading day, is called the fund's net asset value. The number of shares you receive from a given dollar investment is based on this net asset value. You'll likely get fractional shares too, because you're buying an exact dollar amount of the fund, not a specific number of shares. Regardless, both the price and number of shares you receive will be based on the value of the mutual fund at the close of trading, not the value when you decided to act. An ETF works differently. When you want to buy shares of an ETF, you simply enter in a buy order into your brokerage account, just like you would a regular stock. You can place your order either at the market price or at a particular limit price you've chosen to wait for. The broker then goes into the market and finds someone willing to sell those shares. They complete the transaction for you and deliver you your shares, and you pay the brokerage firm. There are a few important differences at work here. First, notice that you didn't send money directly to the fund company. Instead, as with any regular stock, you went into the market to buy shares from another investor who wanted to sell. And importantly, you did this exactly when you wanted to, not at 4 p.m., but at 10 a.m. or 12:30 or 2. But how does your money end up in the hands of the fund company so that they can buy stocks to make up the fund's investments? This is the key to what makes an ETF an ETF and why they are such low-cost, tax-effective mechanisms. It's a bit complicated, but it's worth understanding. As with mutual funds, the best way to understand how an ETF works is to understand how the very first shares of an ETF are created. Since shares of an ETF can only be bought or sold on an exchange, no one can buy shares until the fund is trading. It's a bit of a chicken and the egg problem. So before an ETF can launch, an institutional investor called an authorized participant must put up seed capital to create the first group of ETF shares. Typically, this authorized participant, or AP, must commit $2.5 million to create 10,000 shares of an ETF worth $25. They can then go out into the market and sell those shares to the highest bidder. Note, however, that the AP doesn't simply send his $2.5 million to the ETF manager. Instead, it's the AP's job to buy all the stocks and bonds that the ETF is supposed to hold and submit that to the ETF company instead. Here's how it works. Imagine you have an ETF that is designed to track the S&P 500. The AP who wants to create new shares of the ETF will buy up $2.5 million worth of all the stocks in the S&P 500. They'll make those purchases in exactly the right percentages to track the index. If a stock has a 1% weight in the S&P 500, the AP will buy $25,000 worth of that stock. Once they've bought up all the stocks in all the right proportions, the AP then delivers them to the ETF company. In exchange, the ETF company sponsor will create an equal value of ETF shares and give them to the AP on a one-for-one trade. The transaction works beautifully. The ETF company gets the stocks it needs to track the index, and the AP gets the ETF shares he needs to sell in the open market. Importantly, the process continues on an ongoing basis throughout the life of the ETF. If an AP ever senses that there's demand for more shares of an ETF, he can create new shares using the same process. The process can also work in reverse. If an AP has a certain number of shares of the ETF, often 50,000 or 100,000, they can deliver them to the fund sponsor and get the underlying stocks in exchange at fair value. The AP can then sell those stocks into the public market if they choose. As an individual investor, you don't have to worry about any of this. It all takes place in the background. When you want to buy or sell shares of an ETF, you can do so through your brokerage account, plain and simple. But for reasons I'll explain in the next few slides, this creation and redemption process is what makes ETFs great, so it's all worth understanding to get the gist of it.